A friend of mine, let's call him Daniel, had around $82,000 invested by the end of 2021. And this guy wasn't reckless. He wasn't gambling on crypto coins with dog logos. He wasn't day trading options at 2 o'clock in the morning. He did exactly what every personal finance expert tells normal people to do. Every month, automatic deposits into index funds, mostly the S&P 500, consistent, responsible, boring, the kind of investor financial advisors love. And then 2020 happened. Inflation exploded. Interest rates jumped. Tech stocks crashed. The market started bleeding month after month. And Daniel watched nearly $27,000 disappear from his account faster than he thought was possible. But here's the part that really messed with his head. He realized that for years, he had been told one thing over and over again. Just buy the S&P 500 and wait. That was the entire strategy. And suddenly, for the first time, he started asking a dangerous question. What if that advice is incomplete? Because here's the uncomfortable truth nobody likes talking about. The S&P 500 is an incredible investment until it becomes the only thing you own. And when that happens, your entire future becomes dependent on one country, one market cycle, and one economic environment continuing forever. That's not diversification. That's concentration disguised as safety. Now, I know that sounds extreme. Stay with me, because by the end of this video, you're going to understand why millions of investors are quietly sitting inside fragile portfolios without realizing it. And more importantly, I'm going to show you a 5-part ETF structure designed to survive crashes, inflation, recessions, AI bubbles, and even entire lost decades where the market basically goes nowhere. And trust me, once you see how this works, you'll never think about investing the same way again. So let's start with the real problem. Most investors think average returns are what matter. They hear the S&P 500 averages around 10% annually over long periods, and they assume the math automatically works in their favor. But the market doesn't move in straight lines. It moves in violent cycles. Huge rallies, brutal crashes, long flat periods where it feels like nothing is happening. And the timing of those cycles matters way more than people realize. Let me give you an example. From 2000 to 2010, the S&P 500 delivered basically zero real returns for an entire decade. This period became known as the lost decade. Think about that for a second. 10 years of investing, and after inflation, investors were essentially stuck in place. Now imagine retiring at the beginning of that period. First, the dot-com bubble crashes. Your portfolio gets destroyed. Then it recovers for a few years. Then 2008 arrives and crushes the market again, to massive collapses inside 1 decade. This is what I call the timing trap. If major losses happen early in retirement, or during the exact period you need money, your portfolio can get permanently damaged even if markets recover later, because now you're forced to sell investments at terrible prices just to survive. That's the hidden weakness inside the just buy the index strategy. It assumes your timeline perfectly matches the market's timeline. Reality doesn't work like that. And right now, in 2026, markets are expensive again. AI hype is everywhere. Tech valuations are stretched. Everybody feels optimistic, which historically is exactly when people become blind to risk. I'm not predicting a crash tomorrow. Nobody knows that. But I am saying this. If your entire net worth depends on US tech stocks continuing upward forever, you're taking far more risk than you probably realize. So how do we fix this? We build what I call the resilient portfolio. 5 ETF layers, each one solving a completely different problem, each one protecting you from a different type of economic disaster. And together, they create a structure designed not just to grow wealth, but to survive uncertainty. Layer 1 is the core foundation, around 45% to 50% of the portfolio. This is still broad stock market exposure, because despite all the fear online, businesses still create enormous wealth over time. Innovation continues, productivity grows, economies expand, but instead of blindly owning only the S&P 500, we create flexibility. VTI is one of the best choices here. Vanguard Total Stock Market. It owns virtually the entire US stock market. Big companies like Apple and Nvidia, but also smaller businesses most people never think about. Thousands of companies inside one ETF. And the expense ratio is tiny, around 0.03%. That sounds insignificant, but over 30 years, low fees matter enormously. A high-fee fund quietly steals compound interest from you every single year. VOO is another strong option if you want slightly more concentration. In America's largest corporations, historically, mega-cap tech companies dominated returns over the last decade, which helped VOO outperform broader funds slightly. And if you want maximum diversification globally, VT owns thousands of companies across the entire world. America, Europe, Asia, emerging markets, everything. Because here's something investors constantly forget. No country dominates forever. In the late 1980s, Japan looked unstoppable. People genuinely believed Japan would own the future permanently. Then their stock market collapsed and stayed weak for decades. History changes faster than investors expect. This first layer is intentionally boring. That's the point. Foundations are supposed to feel stable, not exciting. Now comes layer 2. And honestly, this might be the most psychologically important part of the entire portfolio. Cash flow. Most growth-focused investors only make money when they sell assets. That works beautifully during bull markets. But during crashes, it becomes a nightmare. Imagine retiring during a recession. Your portfolio falls 35%, but your bills don't disappear. Your mortgage still exists. Food still costs money. Electricity still costs money. So now you're forced to sell investments while prices are depressed. You're destroying your own future just to survive the present. Dividend ETFs help solve this problem because they create internal income. SCHD is one of the best examples. It focuses on companies with strong balance sheets, healthy profits, and long histories of paying dividends. Real businesses generating real cash flow. The yield usually sits around 3% to 4%, and those payments continue arriving even when markets become chaotic. That changes investor psychology dramatically, because when your portfolio keeps producing cash during bad markets, panic decreases. You stop feeling completely trapped. VIG is another excellent option for investors wanting dividend growth instead of maximum current income. These are companies consistently increasing payouts year after year. And then there's DGRO, which sits somewhere between aggressive dividend growth and stable income production. The exact ETF matters less than understanding why this layer exists. This layer stabilizes your emotions, and emotional stability is one of the biggest competitive advantages in investing. Now let's move into the most misunderstood layer, protection. Most people think diversification means owning 500 different stocks, but during real market crashes, correlations increase. Everything falls together. That's why true diversification requires assets that behave differently under stress. Gold is one of them. And yes, I know people love making fun of gold investors. Warren Buffett famously criticized gold because it doesn't produce earnings or innovation. But gold isn't supposed to outperform technology stocks during bull markets. Gold is insurance. Governments print money constantly. Debt expands constantly. Currency purchasing power slowly declines over time. That's inflation. Gold historically performs well during periods of monetary instability and fear because it cannot be created infinitely. During the 2008 financial crisis, when the stock market collapsed, gold performed incredibly well. That's not random. That's the role it plays. SGOL is one of the best low-cost physical gold ETFs available. IAU is another strong alternative. You don't buy this layer hoping it becomes your best performing investment. You buy it hoping you never truly need it. Because if gold massively outperforms everything else, it usually means financial systems are under serious stress. Now layer 4, international diversification. This is where most investors become uncomfortable because people naturally trust their home country more than foreign markets. But that creates a dangerous blind spot. Right now, US markets dominate global investing conversations. American tech companies became incredibly powerful. The dollar remains strong. Capital keeps flowing into US assets, but market leadership always rotates eventually. International stocks currently trade at much cheaper valuations compared to many American companies. In some cases, you're buying the same dollar of corporate earnings for almost half the price overseas. VXUS gives exposure to thousands of companies outside the United States, European manufacturers, Asian semiconductor giants, global consumer brands, international banks, everything. VEA focuses specifically on developed international economies like Japan, Germany, Switzerland, Canada, and the UK, and VWO targets emerging markets where population growth and industrial expansion could create enormous long-term opportunities. India, Southeast Asia, Latin America. Yes, emerging markets are volatile, but volatility and opportunity usually travel together. This layer exists because history never moves in straight lines forever. Empires rise, empires slow down, leadership rotates. Owning international exposure protects you from becoming overly dependent on one country, staying dominant permanently. And finally, Layer 5, the growth accelerator. This is where we target the future directly. Artificial intelligence, semiconductors, robotics, cloud, infrastructure, automation. These industries are reshaping the global economy in real time. Ignoring them completely would be a mistake. QQQM is one of the smartest ways to gain exposure because it owns dominant technology companies while remaining more diversified than pure semiconductor funds. You still own Nvidia, Microsoft, Amazon, Meta, Apple, and Google. Businesses generating billions in cash while also leading the AI revolution. For more aggressive investors, SMH and SOXX provide direct semiconductor exposure. These ETFs target the companies building the actual infrastructure, powering artificial intelligence. But let me be very clear here. This layer can become extremely volatile. Semiconductor ETFs can drop 40% or even 50% during bad years. If you panic easily, this section should remain small. That's why position sizing matters so much. You want enough exposure to benefit if AI transforms the economy, but not so much exposure that volatility destroys your discipline, because discipline matters more than prediction. So let's bring everything together. Around 50% in VTI, VOO, or VT, the core wealth building engine. Around 20% in dividend ETFs, like SCHD, VIG, or DGRO, the cash flow layer. Around 5% to 10% in SGOL or IAU, the protection layer against inflation and systemic fear. Around 10% to 15% internationally through VXUS, VEA, or VWO, and roughly 10% in QQQM, SMH, or SOXX for a future-focused growth. Every piece has a purpose. That's what sophisticated investing actually looks like. Not chasing trends, not gambling on predictions, preparation. Because eventually another crisis will arrive. Maybe inflation, maybe recession, maybe debt problems, maybe an AI bubble collapsing, maybe geopolitical instability. Nobody knows exactly what causes the next major downturn, but something always does. And when it happens, fragile portfolios break emotionally long before they break financially. The investors who win long-term aren't the people making perfect predictions. They're the people structured to survive uncertainty while everyone else panics. That's the real secret behind wealth. Not getting rich quickly, staying invested long enough for compound interest to become unstoppable.